The most prevalent type of gap to take place in the market is called a common gap for the obvious reason they're the most abundant. They occur when a security ends the session at one price level and then open the following session at another price level. Common gaps tend to form when a security is trading within a range, and they tend to fill rather quickly and easily. They're usually relatively minor gaps representing only a small percentage of an average day's range. RGLD contains a number of examples of very typical common gaps. For instance, let's look at this gap here, which took place on the 9th in May. It closed about the middle of the day's trading range, and then the following Monday, it opened slightly higher. But notice that on Friday, on the 9th, that RGLD traded primarily within the range of the previous session, and this started out a trading range. The range continued with the common gap into the next morning, and another common gap following that into Tuesday the 13th. There was a small gap lower, and it pulled up a little bit into the closure of the gap, and then another gap the next day. This continued until it finally broke free of that trading range. Each of these gaps within the range itself is referred to as a common gap. A number of additional common gaps took place towards the end of May and heading into June. For instance, on the 28th of May, RGLD closed near the highs of the day's range after forming this engulfing candlestick pattern of the previous session. It closed near this high and then opened slightly lower the next morning. It then closed most of that gap that same morning very easily before again gapping into the next morning with a small minor gap higher after closing near the end of the day's lows. These types of gaps made up the majority of the gaps within this larger trading range throughout June and going into the end of the month. Generally speaking, common gaps are not the type of gaps that are going to lead to strong momentum in a security. So for the most part, even though there can be some decent intraday setups coming out of common gaps, they tend to be based upon other triggers such as different support and resistance levels, smaller intraday patterns, and the like. And in and of themselves, they offer very little opportunity for strong momentum moves following them. So for the most part, they're going to be of very little interest to traders that are looking to take advantage of larger expansive moves. If you'd like to learn more about gap analysis, be sure to check out my website, tonihansen.com, or go to www.tradingfrommainstreet.com. I can also be reached through my email at toni@tradingfrommainstreet.com.